Okay, good morning, everybody. We'll start the class now. This is 8:25, 8:26. We're going to be running through capital allowance the next 2 weeks. And I know hopefully we should be able to get to a particular, should be able to get understanding of what capital allowance intends to achieve. In our last class, we talked about the concept of adjusted profit, where we talked about the trading profit and loss adjustments, where we discussed allowable expenses and non-allowable expenses, and how it impacts our tax computation. That was discussed subsequently last week. Today, we're going to be looking at capital allowance, and you remember one of the disallowable expenses that we talked about in our last class was depreciation. We said depreciation is just an historical cost, is the spread of the historical cost of the assets over the estimated useful life. And depreciation does not involve movement of cash. Therefore, we say depreciation is not an allowable deduction. Now, if depreciation is not an allowable deduction, I now told you that depreciation could also mean you are setting aside some certain of money against future replacement of the assets. So that is what depreciation actually does. It's not as if, so when you acquire an asset today, you would, most of the companies usually have a 4 years timeline to write off the assets. So we are saying that a company that has written off an asset for some particular period of time are doing so because at the end of the useful life of the asset, they have been able to set aside part of their profits to acquire additional assets or to replace the assets. So indirectly, depreciation is used for the purpose of saving and replacement and old assets. Now, you remember capital gains tax also talks about replacement of an asset through rollover relief. So, but today we're not looking at capital gains tax, but we are looking at capital allowance. What does capital allowance say? Capital allowance, having known that depreciation is not a liable reduction, so there is a replacement of capital allowance now, capital for depreciation, which is called the capital allowance. So capital allowance is an allowance granted to a taxpayer that has incurred qualifying capital expenditure and put them into production use at the end of the basis period. So this is what we are saying. We are saying that companies acquire qualifying capital expenditure, which is the same thing as non-current assets. Now, this qualifying capital expenditure acquired by company are expected to be put into production use at the end of the basis period so that they can claim an allowance on that asset. Now, having said that, when you talk about capital allowance itself, we can say simple definition of capital allowance is that capital allowance is an allowance granted in lieu of depreciation. It's an allowance granted in lieu of depreciation. That is, instead of granting depreciation, capital allowance will be granted. Okay, and this will be relieved or removed from your profits to ascertain your total or taxable profit in a year. So I will say this. When you talk about capital allowance, I have said capital allowance is allowance granted by a taxpayer to a taxpayer who has incurred qualifying capital expenditure and put same assets into production use at the end of the basis period. So that means you must have used these assets in generating taxable income. So, and I told you that capital allowance, for example, is granted on non-current assets. That is, the same assets that you have in your financial statements is the same assets that we calculate our capital allowance on here. Meanwhile, we are now saying that for this purpose, capital allowance is granted on qualifying capital expenditure. By implication, it means not assets will be qualified for capital allowance, for example, not all assets. And that is why we call it qualifying capital expenditure, because there are some assets that will not meet the threshold. For example, a company acquires stapler. Stapler can last for more than 1 year. And you remember when we were discussing what capital expenditure means, we said these are expenditure that their lifespan goes beyond 1 year. Now, a challenge has now come to you. I haven't given that definition that we said capital expenditure that their useful life is beyond 1 year. I put it to you that stapler can also use more than 1 year. Stapler can also use more than 1 year. Abi? Now, are we also going to be calculating capital allowance on stapler? The answer will definitely be no, because most of the company, even though they know by the principle of accounting that when we say stapler goes beyond, the useful life of stapler is beyond 1 year. Companies will not be capitalizing stapler. What most company does is that stapler will be expense. They are going to expense the stapler. So that means not all assets will be qualified for capital allowance, because not all assets are qualified capital expenditure. Okay. Again, imagine if you buy land, land does not depreciate. Land does not have useful life. How do you want to calculate capital allowance on it? Knowing fully well that capital allowance is more or less like what depreciation does is what capital allowance does. Okay, capital allowance on land. Land does not have useful life. So any asset that does not have useful life cannot be termed as qualifying capital expenditure. So land is an example of that. Land does not have a useful life, therefore it cannot be used as qualifying capital expenditure. Land is not the same thing as building. Okay, so building is different from land. Building, according to Capital Allowance Act, Schedule 4, 5, no, Schedule 4, talks about land, building, and building is divided into two. We have the industrial building and non-industrial building. In all this, land was not mentioned. Therefore, land does not qualify for capital allowance. Okay, I haven't argued that land does not qualify for capital allowance. We can go further by saying examiner at times are funny. In a situation where examiner gives you land and building together, they merge it. They just said land and building. What the examiner is expecting there is that you should calculate annual allowance or initial allowance, as the case may be, on the building, not the land. So, and again, you might not be able to separate the cost of the land from the building. So you just take everything and calculate it and assume that is the qualified capital expenditure, that is both land and building, assume. But ordinarily, examiner should not set question where they will not put land and building. But if they put it, just assume it is building. Okay? So that is that. So I have said that capital allowance is allowance granted to a taxpayer that has incurred qualifying capital expenditure and put it into production use at the end of the basis period. So this capital expenditure must be put into production use, and before it can be granted, before you can grant capital allowance on it. Now, I haven't said this. We quickly move on to the next one, which is what are the features of capital allowance? Number one, feature is that capital allowance is based on a straight line method. When you're calculating your capital allowance, so it is on straight line method. And one thing that you also need to note is that standardized rates is applicable to the taxpayer. Now, what do I mean by standardized rates? Imagine two taxpayers, taxpayer A and taxpayer B, acquire the same asset and put same assets into production use at the same date. These two taxpayers will be claiming the same amount of capital allowance, provided that they put it into production use at the same date. Unlike your depreciation, there is no standard that says that taxpayer that has acquired the same assets and put it to production use at the same date must calculate or use the same depreciation method. So they could decide to use straight line method. The other one could decide to use reducing balance method. At the end of the day, the two of them will be calculating different amount of depreciation. So what we are trying to say here is that for capital allowance purpose, standardized rate is applicable. In your depreciation, there is nothing like standardized rates because the standard does not make it so for all the taxpayer, for all the users of financial statements. So they could decide to use any accounting method, any accounting rate, as the case may be. Excuse me. So sorry, I quickly went to get my glasses. I'm having itchy eyes. So sorry about that. We'll continue the class. Okay. So as I was saying, I said for capital allowance, the taxpayer does not have any liberty to choose different rates because the tax authority or the tax law had made it mandatory for all the taxpayers to use the same tax rate. So that means if you are a taxpayer that has acquired the same assets as another taxpayer, every one of you will calculate the same amount of what? The same amount of capital allowance will be charged, provided you put the asset into use at the same date and provided they are of the same category. The method is uniform and consistent to all taxpayers. Equal amount will be granted to taxpayer, provided the assets were acquired and put to production use at the same dates, and the cost are the same. The same set of rule is applicable to all the taxpayer. Now, what are the benefits of claiming capital allowance? Number one benefit is that you can claim an immediate tax or cash benefits. What do we mean? Now, by implication, what we are trying to say here is that the taxpayer can claim cash benefits. Now, the tax authority too is not as if they are not wise, because the tax authority wants the taxpayer to also invest in the economy. And that is why they are giving this kind of allowance. So taxpayer can actually benefit from this by getting tax relief or cash benefits almost immediately. Again, it reduces or completely shelter a tax liability. It's the same thing. It takes away the cash liability, the tax liability on the part of the taxpayer. Having said that, another thing that is very important about cash or about capital allowance is that your cash flow is maintained. If you have a good cash flow to run your business, the money that you've taken from government as a form of capital allowance can be plunged back into the business. Okay, it can be plunged back into the business. At the end of the day, there is going to be a possibility of you getting your cash refund back or that tax that you have paid back. And when does this happen? When a company sees this operation today and they have capital allowance that they've not fully recovered, the company can go as back as 5 years before the year of cessation to recoup their capital allowance from their profits. When we get there, we'll cross the river. So that is that. So those are the benefits that you can get from capital allowance. As I said, you can reduce your tax liability with you investing in capital expenditure. It improves your cash flow. You can even use the money that you have gotten, that you have used to reduce your tax liability, to reinvest and plugging it back into the business. And in case of cessation, the company can actually get repayment the tax that they have paid, they can get it back on the capital allowance. If you are there, I am there. If you are there, I am there. Okay. The next one that we're going to be talking about is conditions. The next one we're going to be talking about is conditions allowance. Number one that is very important is that the expenditure must be incurred. The person making the claim must be the one that have incurred, must be a beneficial owner. Okay. The person making the claim must be the owner of the assets. So if you are the owner of the asset, you can make claim over the assets. Now, the asset must be used even at the end of the business period. So you can see that we underline must be used at the end of the business period. The next one. The next one. That the capital allowance, capital expenditure must be used for the purpose of trade or business. So before you can say you want to calculate capital allowance, that asset must be used for the purpose of trade or business. Any private portion will be calculated and disallowed by the tax authority. Before you make the claim, you must write to the tax authority that I want to make this claim. And a certificate of acceptance must be required when the asset value is more than 500,000. Okay, common errors or mistakes usually made by taxpayers in claiming capital allowance. Most of the time, taxpayers does not have sufficient information or treatment of certain type of expenditure as capital expenditure. So you have included what is not supposed to be part of capital expenditure in your books, then the tax authority will disregard that. At times, some taxpayer lack, because due to their lack of knowledge, can actually exclude some certain expenditure that qualifies for capital allowance unknowingly. And tax authority will just do as if they did not see it. And they will move ahead. So that is that. What is the implication of this? If you've underclaimed, the taxpayer may not have claimed the full amount of allowances, thereby eroding their tax saving. Overclaiming. If the tax claim is audited, if the taxpayer claim is audited by revenue, the taxpayer may be leaving the company or business open to repayment of underpaid taxes. And that is that. Restriction of capital allowance or usage. Now, basically, capital allowance is calculated all through the year. I mean, you must not stop using the assets. The asset must continue to be in operation. However, where the taxpayer only use 1 day or it does not use the entire day, the assets will be prorated. The capital allowance will be prorated. And this is only done when a company just commences operation or ceases operation. Because when an asset is acquired, irrespective of the number of days in which the asset is acquired in a particular basis period, full capital allowance will be granted. This is what I am saying. You know, your depreciation, when you are calculating depreciation, you only calculate depreciation for the number of periods or number of months in which depreciation, the asset is used, right? In a particular accounting year. This is not the same in capital allowance. For capital allowance purpose, when an asset is acquired, right? Even if it is 1 day in a particular basis period, you are going to calculate the full capital allowance for it. What we are now saying directly now is when a capital allowance, when an asset is acquired during commencement of trade, because I have taught you that basis period during commencement of trade will not be up to 12 months, might not be up to 12 months, let me put it that way, because there are some companies that might decide to start like maybe middle of the year. So in calculating capital allowance, by the time you use your basis period rule, which says from the date of commencement to the end of the accounting year, they might only have maybe 3 months in that year. So when you're calculating your annual allowance, that will be prorated. That's number one. Number two is if there is any private portion that has been ascertained by the tax authority, that private portion will be removed. So it's going to be restricted, you're taking it out. Anything that you are using must be for the purpose of the business. So that is that. Before we move on, basically, there are two types of capital allowance. Basically, there are two types of capital allowance. The first one is the initial allowance. And the second one is the annual allowance. I'll say that again. The first one is the initial allowance, and the second one is the annual allowance. The third one that you see there is as a result of disposal. When an asset is disposed, it is either the company makes profit on disposal or loss on disposal. So balancing allowance is more or less like a loss on disposal. And how do we mean? When a company disposes an asset, you are comparing the sales value of that asset with the tax return value at disposal. So if the tax return value at disposal is more than the sales value, then we're going to have what we call balancing allowance. So balancing allowance is as a result of disposal of asset, but basically we have two types of allowances: initial allowance and annual allowance. Before 2023 tax year, we used to have what we call investment allowance. But with effect from 2023 tax year, investment allowance is no longer applicable to the tax authority. Now, for investment allowance, what do we mean by investment allowance? Investment allowance is an allowance that is granted to a taxpayer that has incurred qualifying capital expenditure on plant, equipment, and machinery. That is for reconstructive investment allowance. We now have what we call rural investment allowance. For rural investment allowance, then, before the extinction of this tax law, we said when a taxpayer uh, locates its business in a place that is not less than 20 kilometers from a normal facility, when a company establishes its business in a location that is not less than 20 kilometers away from the normal facilities, the taxpayer shall be granted the following allowances. Number one, where the taxpayer incurs qualifying capital expenditure on electricity, we say 50% of the qualifying capital expenditure incurred will be granted as relief. Number two, where the taxpayer incurs qualifying capital expenditure on water, we are saying 30% of the amount incurred will be granted as relief. The next one is, we said where the taxpayer incurs qualifying capital expenditure on tarred road, as in you tar the road, 15% of the qualifying capital expenditure incurred will be granted as relief. So when you add all those together, you have 95%. 50 plus 30 plus 15, that is 95%. Before 2007 tax year, we usually say where there is no telephone, 2011 rather, we say where there is no telephone, the taxpayer will be getting 5% of the qualifying capital expenditure incurred in installing the telephone gadgets. But with 2011, that was taken out of the Tax Act. So we now have where there is no electricity incur, any expenditure incur in constructing and bringing power to your business location. You have 50% of that as allowance. Where there is no water, you de-borrow 30% of that as allowance. Where there is no tar road, you did road, 15% of that will be an liable deduction. Okay, that was what investment allowance was doing then. But unfortunately, the Tax Act removed that in 2023. That's why we're not going to be bothering ourselves with that. Okay, if you are there, I am there. Do you have any question? Are you saying no sound? Jesus Christ.
We can hear you.
When I just saw no sound. Okay, maybe when I left to get my glasses. Oh, sorry about that. All right. So, as I was saying, I said we have two types of allowance. We have the initial allowance and the annual allowance. But before we go ahead, let's quickly talk about what we mean by qualifying capital expenditure. I have explained it the other time. I said qualifying capital expenditure are expenditure incurred for the purpose of any income and qualifies for grant of capital allowance. By implication, it means that not all fixed assets of the company qualifies for capital allowance claim. Okay, we have said that before. And we have various types of capital allowance, capital expenditure rather. We have qualifying building. Under that, we have industrial building and non-industrial building, qualifying agricultural expenditure, qualifying mining expenditure, qualifying plant expenditure, qualifying plantation expenditure, we say qualifying research and development, public transportation motor vehicle expenditure, public transport intercity new mass transit coach of 25 seats and above, and qualifying capital expenditure on development or acquisition of software or other capital outlay of electronic application. This last one was introduced in 2019 by Finance Act. Virtually all these other ones that you are seeing here has been there since 1993. Okay, now you remember in those days, it's a big deal for a company to acquire an intercity bus that we have 25-seater capacity. It was treated as an investment in those days. So even though it's still applicable now, but I know that that must have been the reason for the inclusion. So what is initial allowance? An initial allowance is the allowance granted a taxpayer that has incurred qualifying capital expenditure once throughout the useful life of the asset. It is granted once throughout the useful life of the assets by implication. It means it is not granted all through the useful life of the assets. So what are the characteristics of initial allowance? Let's go there. We said characteristics. It is granted only in the first year of use of the assets. Number next. It is calculated on agreed costs of the qualifying capital explanation. It is granted once in the useful life of the assets. So it is once you calculate this. You do not prorate it. Okay? It is not prorated. You don't prorate it. And it can be carried forward indefinitely if it is not fully absorbed. Meanwhile, annual allowance is an allowance granted by the taxpayer by the tax authority to the taxpayer. And this allowance is throughout the useful life of the assets. Is granted throughout the useful life of the assets. So if that is the case, we are saying, what are the characteristics of this? It is granted throughout the lifespan of the assets. Number next, we are saying it is calculated using a straight line method. Number next, it is prorated the number of months in the basis period. It is taken into consideration when you are calculating.
dari hamashin. Ya, خلاص. Ya, har sai mun da tiyar riga na. Ya. Hari.
Mute your mic, please. Okay. So we said it is granted throughout the useful life of the assets. And how do we calculate initial allowance? In calculating our initial allowance, we will say costs multiply by the initial allowance rates. So if the cost of the asset is 100K and the rate of initial allowance is 20%, I'll just say 20% of 100K, I have 20K. Okay? And just like I told you, you do not prorate initial allowance. It is going to be granted in full, unlike the other one that is prorated. This is not prorated. The next one is your annual allowance. How do you calculate annual allowance? That is where calculation starts, really. Your annual allowance is calculated on costs minus initial allowance divided by N. Costs minus initial allowance divided by N. What is N? Your N is the number of years the asset will use. What is I? I is your initial allowance that you have already calculated. And how do you get your N? Your N will be 100% divided by annual allowance rate. So if I have my annual allowance rate will be 25%, my N will be how many years? 4 years. That is 100 divided by 25. That will be 100. That will be 4 years. Now, when do you use this formula? You use this formula to calculate your annual allowance where the basis period is not less than 12 months. That is, your basis period is equal to 12 months. When do you use this formula? You use this formula when your basis period is equal to 12, is less than 12 months. When your basis period is less than 12 months. Okay? So if that is the case, what is Y in this scenario? Y in this scenario is the number of months in which the asset will be put into production use. Number of months in which the assets will be put into production use within the basis period. And 12 is the number of months that we're supposed to have on a normal basis, 12 months. So that is that. Excuse me. Okay, let's continue. Sorry, I have to go and take water. So I said when you are using this formula is when your basis period is not up to 12 months. When you use this formula is when your basis period is equal to 12 months, right? So, and I've told you that Y is the number of months in the basis period. Okay? Having understood that, let's really talk about some tax implication of assets acquired on second-hand basis. Basically, when we're talking about assets acquired on second-hand basis, we're going to be looking at two types of assets. We'll look at our regular assets and building. By implication, we are saying when building is acquired on second-hand basis, the tax implication shall be the annual allowance to be calculated shall be on lower of original cost of the assets and the new purchase price. Okay? When an asset is acquired on second-hand basis, especially building, the annual allowance to be computed shall be on the original cost of the assets of the building and the new purchase price. Whichever is lower, that is the lower of the two, is what you are going to compute the annual allowance on. Meanwhile, when a building is acquired on second-hand basis, no initial allowance should be granted. No initial allowance should be granted. Now, for other assets, when other assets is acquired on second-hand basis, no initial allowance should be granted. The annual allowance should be granted shall be based on the unexpired useful life of the assets. The annual allowance to be granted shall be on the unexpired useful life of the assets. one thing that you also need to note is when you are computing your annual allowance for the unexpired useful life of the asset, you have to determine the number of years the asset is supposed to use and the unexpired useful life of the assets. So that is, you know the entire number of life the asset is supposed to use. You will now determine the number of years the asset already used. You will now subtract it from the total number of useful life of the asset. We're going to be looking at that as we move ahead. So another question that will come to your mind is that, what if this asset that we are talking about has never been used for the purpose of business? You remember, one of the conditions for granting capital allowance is that the assets must be used for the purpose of business and must be used for the purpose of generating taxable income. If it has never been used for the purpose of generating taxable income, or it has never been used for the purpose of business, then the taxpayer is allowed under the tax law to calculate initial allowance and annual allowance. Okay? Both for building and other assets. So we can move on to some calculation now. Now, before we continue, it is important that we know that you cannot completely write off an asset in your books. You cannot completely write off an asset in your books. You must retain something. And what you are retaining is 10 naira. You cannot write off your assets completely. You must retain 10 something. And what you are retaining is 10 naira. That means in the last year of use, the taxpayer must retain 10 naira. Okay? In the last year of use, the taxpayer must retain 10 naira. So that is that. And that 10 naira is called residual value. Okay, let's go. Now, under examination condition, examiner will give you this table. So you do not need to cram any rates. According to paragraph 8 of CETA 2004, table 1 and 2, the below are applicable rates. This is the rate. So examiner will give you this rate. Do not cram. They will give you it at the back of the question. So let's look at this one before we go. So we'll go straight to calculation now. Basis period for capital allowance. Basis period for capital allowance. Now, for capital allowance, it is very important that you know that the same basis period that we used for our beginning, when we started this class, is the same basis period that we're going to be talking about here. When a company commences operation, the company is expected to the assess to tax from the date of commencement to the end of the first accounting year end. Okay? So it's the same thing here. But what is the purpose of basis period for capital allowance? The purpose of basis period for capital allowance is for us to be able to know the relevant year in which we are going to allocate our assets for capital allowance purposes. Let me say it again. The reason for basis period for capital allowance is for us to be able to identify the relevant tax year in which our assets will be introduced for the purpose of capital allowance computation. So if that is the case, we can move on. Now let's look at illustration number 1. Let's look at illustration number 1. In this illustration, we have Jessica Venture, a sole trader, commenced business on 1st April 2025 and prepare account to 30/6 annually. The following assets are acquired by the company on the dates shown below. Don't forget, this company commenced this date, and this is the accounting year of the company. We are given the assets. They said motor vehicle, 10 million. Date of acquisition, 1/5/2015. Next, plant and machinery, 1.6 million. When? 1/5/110/2015. Furniture and fitting, 3.6 million. Date of acquisition, 10/8/2016. I have told you, under calculation, under capital allowance computation, it is not the same way you calculate your capital, your depreciation. If this were to be depreciated, we would have said, okay, from 1/10/2015 to 30/6/2015, how many months is that? We would have said maybe 7 months. We will say 7/12, multiply by whatsoever depreciation method we want to use, and get our depreciation for that year. In this regard, that is not the case. And that is the essence of basis period for capital allowance. Let's go. Examiner now says you are required to answer the following. How do you assess qualifying capital expenditure acquired prior to the date of commencement? Any assets acquired prior to the date of commencement will be deemed to have been acquired on the date of commencement. Are you with me? Any assets acquired prior to the date of commencement will be deemed to have been acquired on the date of commencement. So that's that. And that said, prepare asset allocation schedule for 2016 to 2020 year of assessment. Compute the capital allowances claimable on the assets for 2016 rather, to 2020 year of assessment. So the first thing that we're going to do is to prepare our asset allocation schedule, which will include our tax year, our basis period, and our assets to be allocated. So let's go. Don't forget that this company just commenced operation. So we said any company that has just commenced operation will be assessed to tax from date of commencement to the end of the first accounting year end. End of first accounting year end of this company is this date. Abi? That is from 1/4/2015 to 30/6/2015. The next one. For second tax year, we say a day immediately after the end of the first accounting year end to the end of the second accounting year end. A day immediately after this is 1/7/15 to the end of this 30/6/16. Third, the same thing. A day immediately after the end of the second accounting year end to the end of the third accounting year end. To the end of the second accounting year end. Now, fourth and subsequent years will be on preceding year basis, which we already know what preceding year basis is. Or you can also say a day immediately after the end of the third accounting year and to the end of the fourth accounting year, and so on and so forth. Okay. Now, let's now go back to allocate assets. This asset that was acquired, look at it, was acquired 1/2/2015. That was before the date of commencement. Therefore, it should be assumed it has been acquired on the date of commencement. The next one, this was acquired 110. 110, 2015. Where would it fall in our basis period? We'll go back to our basis period. According to our basis period, it will be second year. The next one was acquired 10/8/2016. I'll come back to my basis period. Where can I see 10/8? I can see it here. I put the figure there. So that is your asset allocation schedule. The next one is for us to compute our capital allowance. I have used a different rate here. Why did I use this rate? Because he is an individual. Okay, that's why I've used this rate. So bear with me. Bear with me. For your level, you will not be seeing this kind of rates. You are only going to be seeing another rate. I will explain that when we get to the next question. So when you look at this, the initial allowance rate is 25%. You remember what I told you about initial allowance? You just multiply it by the cost. So 25% of this will give you this, right? Now, you remember that this company or this business has just commenced operation. Commenced 1/4/2016. 2016. Why is it clean? And you know, we said when a company commences operation, it's going to be from the date of commencement to the end of the accounting year, and that is 36/2015. How many months is this? How many months is this?
3 months.
3 months.
3 months.
3 months. So we say 3/12 multiplied by cost minus initial allowance divided by N. So let's go. How many years is our N? You remember I told you N is equal to 100 divided by annual allowance rate. Our N in this situation is 5 years. Abi? So I will now say cost. My cost is 10 million. My cost will be 1 million minus 250,000. The asset is supposed to use 5 years. I will multiply by 3/12. What do you have? What do you have?
37,500.
37,500. Okay. So to get my tax now value, my tax now value is costs minus initial allowance minus annual allowance. Whatever we get, we bring it down. So we get this for our tax nominal value. That is this minus this will give me this. Now, in the second year, if you look at our table, you will notice that we bought plant and machinery. But in this year, our basis period is equal to 12 months. So by implication, we will not be prorating our annual allowance. I go straight. Our cost is 1.6 million. Our initial allowance is what? 20%. 20% of this, 320. Now, we need to calculate our annual allowance for this asset. So I'll just say 1.6 million minus 320. This asset we use 10 years, that is 10%, 100 over 10. So what do we have? $1.6 million minus 320 give us 1,280,000, right? If we divide that by 10, you have 128,000. Abi? So that is that. Meanwhile, in my second year for motor vehicle, our basis period here is equal to 12 months. So we can't be having less than 12 months basis period. Okay? So I will now go back to the initial computation. I will not prorate because my basis period is all up to 12. I'll say 1 million minus 250,000. I will have 750,000. 750,000 divided by 5. I will have 150,000. That's what I will remove from there. Do you have any question on that?
Please come again.
All right. I am saying because the basis period in my second year is 12 months, I will not be prorating my annual allowance in the second year. I need a full annual allowance. To get a full annual allowance, I'll go back to the original cost of the assets. The original cost of the asset is 1 million, right? That's the original cost of the assets. Meanwhile, the initial allowance that we calculated on this asset was 250,000. I'll subtract it. I will have 750,000. How many years is this asset supposed to use by our annual allowance rate? Our annual allowance rate for this question is 20%. By implication, it's supposed to use what? 5 years. So I am now going to say 10. 750,000 divided by 5 years. I will have 150,000. Ordinarily, I am supposed to have prorated it. But because the number of months in the basis period here is 12 months, I won't be able to prorate it. Do you understand me? So that's why I'm having this. The next one. Our tax nominal value in the next year, which is 2018. We know our basis period to be this for 2018. My tax nominal value will be this minus this. I will have this. In this one will be this minus this minus this. I will have this. We acquire new assets. Look at our table. New asset was acquired in 2018. Furniture and fitting. How much did we acquire furniture and fitting? 3.6. Now, our initial allowance rate for furniture and fitting is 15%. 15% of this, it gives me 540. Now, I'm also supposed to use 10 years. I'll say cost minus initial allowance. That is 3 million, 3.6 million minus initial allowance. I will have 3.6 minus 540. I will have 3 million and 60,000, right? 3 million and 60,000 is what I will have. This asset is supposed to use 10 years by the virtue of the rates. It's supposed to use 10 years. So I'm now going to say this minus this divided by 10 years. Why are we using 10 years? Because our annual allowance rate is 10%. Why are we not prorating? Because our base period is 12 months. We don't need to prorate. So we get our answer. So my target value for the first one will be this, and this will be this. Note again that your annual allowance, you don't calculate it every year. Once you calculate in the first year, it's going to remain constant. It is going to what? Remain constant. You don't prorate. And you continue to have it on a daily basis. Okay? On a yearly basis, rather. Continue to have it on a yearly basis. So that is why I did not change this. I'm not going to change this. This is not changed. When you get to the next year, we have our taking down value of this value, taking down value of this value, and that's so our annual allowance of this value. Now, in the last year of use of your assets, you must retain 10 naira. In the last year of use of the asset, you must retain 10 naira. Therefore, this first asset is supposed to use 4 years, 5 years rather. So it has used 1 year as only 1 year, 2 years, 3 years, 4 years. This is the 5th year. In the last year of use, I want to ensure that we restrict it to the what? To the number of years the asset is supposed to use. So in the last year of use, I am going to have the entire value and terminate it here, but ensuring that I retain 10 naira. Why is this not 150,000? The reason why this is not 150,000 is because we have prorated the first year. And when we go to the last year of use, we have not been able to exhaust it. So we need to terminate everything. And that's why we have terminated this. But look at this guy. Our annual allowance is still constant because we have not gone to the last year of use. So this one, it has completely written off. Then this will still continue to have the balance carry forward, which is starting now value. The same thing goes for this. Your annual allowance is 128,000 and 306,000. So you continue to calculate it till, but in this question, examiner says we should calculate to 2021. That was why we are stopping here in 2021. So you can look at the formula computation in the question. So let's really talk about disposal of assets because we are still going to expand this scope.
Hello, sir.
Jerry, you have a question?
Yes, sir. I have a question.
Go ahead.
Please, the first year we prorated the annual allowance. So I want to know that amount the value we got on that first year, that is for motor vehicle, that is 3 months. Does it not have any effect on the written down value when you are calculating for the next year? You know, in that first year we have 3 months, 3 months which amounted to about this thing.
That the 7,500.
That 7,500. So now in the second year, when you deducted it, you have your your tax return value as 712,500. But when we are calculating the annual allowance for the second, that's 2017 basic period, we still have 150 as the annual allowance. And I want to know if that 37,500 did not have any effect on that tax return value as at the second year. I don't know if you understand what I mean.
I know what you're talking about. So in some cases, the way they calculate annual allowance, both are allowed under, for your exam purpose. It's either I say, in my second year of use of the asset, especially when it's prorated, I'll just take the tax return value and divide it by the remaining number of years.
Okay.
That is the other alternative. If you have my textbook, you will see it that way.
Okay.
That is the other alternative. So I'll just take this value and divide it by, we are saying this asset is supposed to use 5 years.
Yes.
In this year, we are assuming it has used 1 year. So this balance will be divided by 4 years.
Okay, sir.
And we'll continue to carry forward the balance. Do you understand?
Sir.
Alternatively,
yes,
instead of you doing it that way, you can say, okay, let me stick to the normal annual allowance this is supposed to have, which is 150,000.
Okay.
That is this minus this divided by 5 years.
Okay.
So I will continue to remove it till we get to the last year. Now, in the last year of use, I have 262,500. If you add 37,500 to this one, you will have 300,000.
Okay.
Abi? But we're now saying that this asset is not supposed to be more than 4 years. If I want to do it by number of months, okay, I would have taken 150,000 here, and the balance I'll bring it to this year again and continue. But it does not make sense that way, and that's why, because the act already says this asset is supposed to use 5 years. If you extend to the next year, that is the 6th year, it's not supposed to be like that. Okay, so that's I'm terminating this year to get my balance of 10 naira, and that's what I'm going to use to compute my balancing charge or allowance when this asset is eventually disposed.
Okay, sir. Okay, sir. Thank you, sir.
All right.
Hello, sir.
Yes.
Hello, sir.
Hello.
Yeah, please. I think I have issues with my. Yes, I think I have issues with my network. Could you please do me the honors of dropping the recorded lecture class once we are done? I'm on and off, so I'm missing some things. I intend going over it again once we are done, sir.
No problem, Alero. We'll try and do that before the end of today. We're also having physical class, so our admin staff are always very busy. But no problem, we'll make sure we drop it before the end of today. I will talk to them.
Thank you, sir.
Any other question? Now, having said that, we need to also talk about when an asset is disposed. Disposal of an asset will come when you dispose or sell the relevant interest in the assets to other parties. You remember when I told you conditions for claiming capital allowance, I said the taxpayer must have a relevant interest in the assets. That is, you must be the owner. Now, when the relevant interest is now being sold or disposed, then the assets is no longer yours again. It has been disposed. So you cannot claim allowance on the assets going forward. So, and there could be various reasons why assets might want to be disposed. Number one is maybe the asset is fully depreciated, or maybe it is obsolete, or maybe there is fire disaster that made the assets not to be functioning, or there are thefts, and so on and so forth. There could also be some financial reason or cost savings. Initially, let's say, for example, you have projected that you're going to be producing 20,000 per day. But because of the way things are, you are now not able to produce 20,000. You are only producing 5,000. That means the capacity of that your assets is too much. So, and the cost of maintaining it is much. So you can now decide to dispose it because you can no longer cope with the cost of maintenance. It could also be for financial reasons. Maybe you need fund. You just want to dispose it. Maybe doing merger and acquisition. The two companies you are merging with another company. You just felt like, okay, let me dispose this asset. Or there is a shift in strategy of the company. Company is shifting from one strategic plan to another one. Therefore, they've decided to dispose the asset. So there could be various reasons. Now, when you dispose an asset, two things will happen. It's either you make profit on the disposal of the assets, or you make loss on the disposal of the assets. It is either profit is made on disposal of assets, or loss is made on disposal of assets. When profit is made, you remember your computation of your profit. You will say when your sales proceed exceed your cost price, then you have made profits. In taxation, profit on disposal is not recognized. Profit on disposal of fixed assets is not recognized. You remember, we said when you make a disposal, when you make profit on disposal, we said it is not taxable because we already have a whole section of the tax law that takes care of disposal of assets of capital in nature. So when you dispose an asset that is of capital in nature, there is a guideline for that. That is capital gains tax. So take that to capital gains tax. It's not here. Now, when there is a loss on disposal of capital expenditure or capital assets, there is a provision for that also in your capital gains tax law. So, invariably, you will not be comparing your sales value with your cost of the assets. For the purpose of calculating our profit on disposal here, we are going to be talking about balancing charge and balancing allowance. What is balancing charge? Balancing charge will arise in a situation whereby the company's sales proceed exceed the tax nominal value of the asset at disposal. Let me say it again. I am saying the sales proceed exceed the tax nominal value at disposal. Therefore, balancing charge will occur when your sales proceed is greater than your tax nominal value at the point of disposal. Balancing charge will occur. We go again. For balancing charge The tax law says that balancing charge cannot be more than the total allowance claimed on the assets. I am saying, for example, when you have your sales proceed and you have total allowance claimed on the assets, let's say sales proceed is 5,000, allowance claim on the asset is 500, you have 4,005. Let's say the cost price of the asset is 2,000 naira. To get the total allowance claimed on the asset, I would have said my total allowance claimed on the asset will be my cost price minus tax nominal value at disposal. So you remember I told you the cost price is 2,000. Tax nominal value at disposal is 500. If I compare the two, I will have 1,005. 1,005 there is the total allowance I claimed on the asset disposed. And the tax law says that your balancing charge cannot be more than total allowance claimed on the asset disposed. If that is the case, and I will now say my total assets, my total balancing charge I will claim must be equal to total allowance claimed on the assets. Let me say it again. Assuming your sales proceed is 5 million. What's wrong with this thing now? Or 5,000. Cost price 2,000. Taxing now value at disposal 500. What is balancing charge? Balancing charge will arise when your sales proceed exceed tax nominal value at disposal. So I'll say 5,000 minus 500. And we have 4,005. But we need to calculate the total allowance is claimed on the asset disposed. To calculate total allowance claimed on the asset disposed is going to be cost less tax using now value at disposal. So my cost in this question is 1,005. Sorry, 2,000 minus 500. I will have 1,005. 1,005 is the total asset, total allowance claimed on the asset disposed. And your balancing charge, according to what you have calculated, is 4,005. The act is saying that your total allowance cannot be more than, sorry, your balancing charge cannot be more than total allowance on the asset disposed. Therefore, your balancing charge shall be restricted to the assets total value of your allowance on the asset disposed. So this is the total allowance claimed on the asset disposed. This is the balancing charge. Therefore, your balancing charge shall be restricted to the total allowance claimed on the assets. That is what the ask is. Do you understand? Any question? Let me start all over. I said your balancing charge shall be your sales proceed. Shall be a situation whereby your sales proceed is more than your tax down value at disposal. That is, SP is greater than tax down value at disposal. SP is greater than tax down value at disposal, right? Now, we are now saying that you have computed that. So your sales value is 5 million. This is 500,000. Your tax down value is 4.5. We are now saying that according to the Act, your balancing charge cannot be more than total allowance claimed on the assets. If that is the case, I am restricting it to the total allowance claimed on the assets, which is going to be my total cost. I need to get my total allowance claimed on the assets. How do I get that? To get my total allowance claimed on the asset, I'm going to have my total cost less tax down value at disposal. My total cost less tax down value at disposal. What is my total cost according to this question? My total cost, I said it was 2,000. And my allowance, is 500,000 is 1,005. My balancing charge is 4.5. My allowance is 1.5. So we are saying that your total balancing charge cannot be more than total allowance claim. Therefore, to claim my balancing charge, I am only going to charge to tax 1.5. So the tax authority can only charge me on 1.5, not 4.5. We are going to be doing some explanation as we move ahead. The next one is balancing allowance. What is balancing allowance? Balancing allowance is when your sales proceed is not up to tax nominal value. That is, your tax nominal value is more than your sales proceed. Therefore, you're going to have balancing allowance. For balancing allowance is not restricted to anything. If you have balancing allowance today, it is pink and white. So if you have balancing allowance today, your balancing allowance that you have is going to be an additional allowance. You don't restrict balancing allowance, unlike you usually restrict balancing charge. You don't restrict balancing allowance. So let's look at illustration. Illustration 2. We said an asset has a tax nominal value of 900K and capital allowance both on initial allowance and annual allowance on the qualifying capital expenditure is this. Sales proceed is this. You are required to calculate balancing charge or balancing allowance. Let's go. What's your sales proceed? Your sales proceed is 1.250, right? Your tax nominal value is 900. Balancing charge is what? 350. Abi, you remember we said your balancing charge shall not be more than total allowance claimed on the assets. Total allowance claim on these assets is 223,000. Therefore, balancing charge shall be restricted to the total allowance claimed on the asset, which is 233,333. Do you understand? So that is that. So look at it. 350,000 is what you have, but we have said it will not be more than total allowance claimed on the assets. So this is it. The next one. And I also told you how to calculate your total allowance claimed on the assets, which will be total cost of the acquisition less tax down value at disposal. So you get total allowance claimed on the assets. So let's look at illustration number 3. Illustration number 3. We said the following information relates to the asset schedule of Alice Nigeria Limited. Sales proceed, 10 million. Cost of acquisition, 7.5 million. Tax nominal value at disposal. You are required compute balancing charge and demonstrate how the leftover of sales over the cost of acquisition will be assessed to tax. Compute the total tax liability from this transaction. given that Allowance Nigeria Limited is a large company. Given that Allowance Nigeria is a large company. Excuse me, guys. So, how do we go about this? How do we go about this? Now, the first thing we need to do is to compute our balancing charge. Oh yeah, what is our balancing charge? Me looking at this, what is our balancing charge?
7 million.
7 million.
7 million.
Right? What is the allowance claim on this asset?
4,500,000.
Good. 4,500,000. Then good. Now we are now saying that your balancing charge cannot be more than total allowance claim on the asset, right?
Yes.
So with that, that means we are going to restrict our balancing charge towards 4.5 million, right? Abby?
Yes.
Yes, good. If we are restricted to 4.5 million, what happens to the balance? You remember, we said our balancing charge that we first calculated. Let me show you something. Our balancing charge that we calculated was 7 million. Abby? But we said we should restrict to the actual allowance claim on the asset, which is 4.5 million. Which is 4.5 million. So who is that now? Which is 4.5 million, right? So we are saying that we should claim this instead of this. We should charge this to tax rather instead of this. So what will happen to the leftover? That is what the authority, the question is asking you. That is the difference between this and this. How much is that value? That's
2,500,000.
So what will happen to this 2.5 million?
So capital gain.
The 2.5 million will be subject to capital gains tax. And how do we mean? Look at it. If you say, you know, when you are computing your capital gains tax, we said capital gains tax will be computed based on your excess of your sales proceed and your cost of acquisition and other incidental costs. So your cost of acquisition here is 7.5. Your sales proceed here is 10 million. If you subtract the two, you have 2.5 million. That is capital gains, which is the same thing that happened here, which is the leftover. 7 million minus 4.5 is the leftover, which is the same thing as you saying sales minus cost of acquisition, which is 2.5. So the examiner is now asking you, how do you subject this to tax? What is the total tax liability I'm going to get? Now, on the 2.5, the tax rate on 2.5 is 10%. Abi? For capital gains tax. Abi now?
Yes,
Abi?
sir. Yes.
Meanwhile, for the 4.5 million, it is going to be company income tax. And the examiner here told you that this company, you know, is a large company. By implication, that is 30%. So this will be multiplied by 30%. At the end of the day, I am multiplying this by 30% and I'm multiplying 2.5 by 10%. Do you understand what I've explained?
No, sir, I have problems, sir. I don't understand how do you get 4.5.
4.5 is the total allowance claim on the assets.
Sir, in the question, I didn't see it, sir.
It's total allowance claim on the asset. I have told you to get your total allowance claim on the asset. It is going to be the total cost of the acquisition less taxing down value at disposal. So total cost of acquisition less taxing down value at disposal. You have 4.5 million. Do you understand me? And we said your balancing charge cannot be more than total allowance claimed on the assets. Meanwhile, your balancing charge that you have was 10 million minus 3 million, you have 7 million. We are saying it cannot be more than total allowance claimed on the asset, which is 4.5 million.
Okay, sir.
So that is what the examiner is asking. The examiner is asking you to calculate the total tax liability on the assets. So that's what we have done. So when you look at what we have done here, we have done similar. So you have this. You have this. So total capital allowance on the assets, I did not put it. Okay. So that means to get that, I'm going to have, you remember we got the 2.5. That is 10 million minus 7.5. Abi? That will be 2.5, 10% of that. Meanwhile, this one will be 30% of this. So you get your total tax liability. Now, okay, this is where it is. It's different. The next one is balancing charge. Balancing allowance, rather. So balancing allowance will be when your sales proceed is less than your taxing down value at disposal. So look at it. So we have a sales proceed of 1.250 and taxing down value of 1.9. So when you subtracted it, you have 650,000, right? So we are saying that this is an additional allowance that taxpayer will claim. Do you understand? So that is that. So this is for you to go and digest. The following information relates to the asset of Mega 99 Nigeria Limited. Sales proceed, 1.5. Cost of acquisition, 10 million. Taxing down value at disposal, this. Demonstrates you are required to compute the allowance and demonstrate the effect of balancing allowance on company profits. Now, you remember, look at it. Sales proceed minus taxing down value will be what? Will be your balancing charge allowance, Abi? So we have balancing allowance of this. Now, total cost of the asset of the company is this. And you said to get the allowance claimed on the assets will be total cost of the assets minus taxing down value at disposal. So they have claimed, before now, this company have claimed 6,250,000, right? And we are now saying that what is the effect of all this on the company's profits? The company is going to have 100% relief. The 1.5 million will go as a relief against the company's profits. The total allowance claim will go as a relief against the company's profits, and the balancing allowance of 2.5 will go as against as additional relief for the company. So that is that. Do you have any question? Do you have any question? Okay, in the absence of no question, we'll continue from here next class. Good day to you.